Hi, welcome to day 12 of You Can Become a Master Series 1. Today, we will understand the definition of debentures, trading with debentures, and what makes debenture trading very interesting. Debenture is a type of secured unsecured business loan issued by the companies offering fixed interest for a definite tenure. Normally, interest is paid either yearly or half yearly. Debentures can be redeemed or converted fully, partially to equity shares as per the agreement. Therefore, we have convertible, partially convertible, secured, unsecured debentures available for trading. Debentures are traded just like equities. Price and value of debenture are based on interest rate in the market and the risk profile of the debenture, mainly the companies which issue them. Because companies with lower credit quality issue debentures with high interest rates than more credible companies. In India, to buy and sell debentures, you need to have a demat cum trading account with your broking firm, and it should be linked to your primary bank account. Debentures are traded in leading stock exchanges like National Stock Exchange NSE, Bombay Stock Exchange BSE. You can find them in capital market segment in NSE and the F group on BSE, where the scriptwise code and codes are available. Now, why buy debentures? Because debentures are much safer than sometimes equity shares or other forms of investments, because it guarantees you a fixed interest which the company should pay whether they are making profit or losses. This is the cost to company against their investments, against their business, and it is not depending on the profits that the company makes. Debentures are available as a primary as well as in the secondary markets. In the secondary markets, people go and buy debentures mainly because of the interest rate it offers for the coming years. An example, supposing a debenture offers you 12% interest rate for the next 3-4 years when it can be redeemed. Let us say the original price of unit value of debenture is rupees 100. Now, you are going to buy this because you have about couple of lakhs in your money in your kitty to spare, and you want a good interest rate. They say fixed deposits offer you around 6.57, but you want to better them. Now, you don't mind taking a little bit of risk in buying this in the secondary market. When you go to secondary market to buy such debenture scripts, it may not be available to you at 100 rupees, the original issue value, but it may be costing you 110, 112, 115, depending on the current interest rate in the market. You have to only equate that and see whether you are going to gain by buying this at 120 rupees with 12% interest, which may still work out better than what you are getting from your savings account. This is how people start looking at debentures as a viable option, and also you can make certain surpluses over the fixed deposit rates that you normally get in your banks. This is where we are going to learn another concept called yield to maturity, YTM. Yield to maturity is just the annualized return you can earn on any non-convertible debentures if you buy it today and hold it till maturity. YTM really helps in deciding whether it is worth buying a particular scrip or not. The example very clearly tells you whether it is worth buying at 120, whereas you are going to get 100 rupees after 3 years. But in the meantime, you are going to get 12% interest instead of getting 7% interest on your money. You calculate and then you decide this. There are several other concepts relating to this. As we are getting into trading of debentures seriously, we are going to discuss all those concepts. But what about convertible debentures? This is totally a different subject, because if the debentures are convertible into equity shares, then naturally the value of debentures go up. It is not easy to get equity shares on the run in the security market as you want, but you may have to pay the price that is prevailing on the particular day. Whereas when you are going to get a convertible debentures, you may get a very good rate when you get them converted into equities. So there has to be a balance between the rates, and that is where your derivatives and some option tradings come into the picture. More about it when we really start working on derivatives and options on convertible debentures. Till then, bye for now. I will meet you tomorrow with another interesting topic called bonds. Bye for now.